Hi, class. You're never lost on a Harley. Although I have a Triumph trophy right now, I used to have a Harley Ultra. I do like to ride. If any of you want to ride someday, let me know. We will make that happen. Let me go over and share a screen. And I'm going to talk about chapter 3. And in chapter 3, I want to jump over, talk about a modification to our income statement. If we look at our income statement, we do start with revenue. You know about that. But we're going to subtract something that will cost of goods sold. And when we do that, we're going to yield something called gross profit. And the gross profit is the stuff that you are left. Let's say we're going, let's undo that. If we're at Walmart buying that $2 gallon of milk and only cost us $1, we're going to go ahead and deduct that to see the net of what just from the stuff, the inventory that we sold. And they have something called SG&A. Selling, general, and administrative. And actually you'll see this actual terminology on income statements, also known as administrative, right? Probably not. And at that point, we'll yield net income. Okay, so a little variation, revenue minus expenses. We have revenue minus cost of goods sold to get there. And that again, for good form, make it look pretty. So what happens? We're pretty good with double entry accounting. We're going to have revenue, maybe have service revenue, $3,000. And we either got it as cash or as AR. So let's say they owe us the money. So what that means is someday they'll pay us. We're recognizing the revenue. Immediately, our retained earnings went up $3,000. So right here, we got 3,000 more here. We're up 3K. And we're in balance just from that one transaction. But what happens if we sell a product? What happens if we sell a gallon of milk? What happens if Best Buy sells a TV? Well, we go from double entry accounting to quadruple entry accounting. So we have to record a couple of things here. We sell a $500 TV. Or that cost us $4. So what entries are going to make? Well, the accounts what are going to be hit for accounts? Well, we know we got revenue coming in the door, and Best Buy is pretty good at getting cash. If we just did $400 of revenue and $400 of cash, I'm sorry, I'm losing it. $500 for the sale and revenue and $500 in cash. How do we get rid of the inventory that's associated with that sale? So our income statement shows 500 in revenue, 400 in cost of goods sold expense. I'll put it here actually for viewing. So we got $500 in revenue. We got $400 in cost of goods sold, which yields a gross profit of $100. So we got this revenue and cash at our retail at selling price. So is that retail? This is at retail. Inventory is at cost. Because whatever we pull out of inventory is based on what we put into it, and that's what it cost us. The other fancy account we need to get to is COGS, or cost of goods sold, or cost of products sold, or cost of TV sold. There's going to be different names that you'll see, and we'll look at some income statements on another video. So that is also at cost. So we need to go in and figure out, okay, our retail was 500, not 599. Our retail cash was 500. That's what we got, plus some tax. We'll worry about that later. Our cost was 400, and our cost of goods sold was 400. So what are we debiting? What are we crediting? Well, revenue looks like a credit on the right, and cash looks like an asset on the left. So we're going to go, and we're going to, good form, we're going to put a date. We're going to do January 15, X1. Go ahead. We said we debit the asset. So cash is going to be debited for $500. And we said that we have to credit something. What are we going to credit? I'm going to go ahead and credit, you tell me. Any guesses? Well, it looks like we've got TV revenue or just revenue. I'm not particular. Okay. So did our cash go up or down? Let's see, we debited cash. There it is, it went up. And we credited revenue. There it's on the right. We righted the revenue, it went up. And now what goes on? We said we have two more things, inventory and cost of goods sold. Inventory is an asset with a debit balance. It usually shows up somewhere around here. And if I look at that, I say, okay, that's a debit balance, but are we increasing inventory or decreasing? Oh, we sold it. I got to be decreasing inventory. So we're going to credit our inventory to reduce it. What are we going to debit? We're going to debit that cost of goods sold. Okay, so let's go ahead with the debit and the credit. Same day, we're going to go ahead and cost of goods sold. For how much? Not 500 is at our cost, not zero either. And we're going to credit inventory. What's missing from a journal entry in good form? Oh, we need a description. So let's do that. I'm going to take the caps off. Sold stuff. TV. And then I go down here and recognize cost of sold stuff. Get the idea. Two journal entries. We went from double entry accounting to quadruple entry accounting, meaning we have two entries in balance here for the revenue side and the sale, and we have two entries to register the cost of goods sold. We still show a 500 on revenue minus 400 on cost of goods sold for net of $100. So our gross profit of 100. We didn't record any other SG&A, selling general administrative expenses on that, and we have our net income. So our net income increased by $100. Our cash went up 500, and our inventory went down 400. So our assets had a net increase of $100. Okay. So let's take a look at the PowerPoint to go along with this. So service organizations, they sell time and revenue. They have revenues minus expenses is net income. All right, that was pretty easy. That's where we go. The variation we have with merchandising companies, wholesalers, retailers, anybody that manufactures, that sells to manufacturing is another can of worms we'll talk about another time. So we have sales minus cost of goods sold is gross profit. So we'll have a gross profit percentage of gross profit out of net sales. So our $2 gallon of milk that costs us $1, that's a 50% gross profit, $1 out of $2. We take out 90 cents in expenses, we're left with 10 cents in net income. 10 cents out of $2, that's 5%, if you do the math. But here we're looking down at our income statement. Sales minus cost of goods sold is gross profit, minus SG&A or administrative expenses or selling general administrative. Net income of 354. All right, don't worry about tax here. One of the other formulas you're going to want to know, okay, and this is going to kick into high gear when we actually do inventory analysis, LIFO and FIFO stuff. So you're going to start with beginning inventory. We're going to start beginning inventory. We're going to add purchases. We're going to buy some stuff. We're going to end up with gas, which is goods available for sale. Just for kicks. And then we'll go ahead. Oops, I'm not going to italicize it. I just did. I'll underline it. All right. And then what happened? So we had some stuff sitting on the shelf. We had 5 TVs sitting there. We bought 10 more. So now we have 15 TVs available for sale. How many did we sell? Maybe we sold Here are cost of goods sold. We'll start with cost of goods sold. And we end up, if we had 15 total, we sold 12, that means we must have 3 left over in ending inventory. So we look at that, and this is a formula that we're going to be using when we analyze inventory in a big way. And you're going to want to understand the concept behind it and internalize this thing. Because it's either sold or it's here. Those are 2 things you can do. Now, we can do the same formula up here, only we can invert it. And you can say, well, goods available for sale minus ending inventory equals cost of goods sold. For kicks, I'll make it a little neater. I'll put the subtraction sign in there. So that is what's going on when we're looking at inventory. And that's why we have quadruple entry accounting. We have to do debit and credit for the retail price and debit and credit for the cost. And this is a little bit confusing. It does take some practice. So here's it in a graphical form. Beginning inventory plus net purchases equals available for sale. And available for sale will always equal what you sold plus what you still have. It's either one place or the other. Now, there may be shrinkage. Someone might have stolen it, okay? Or maybe at Walmart, they've got a break room and someone grabbed a gallon of milk and brought it up to the break room. Or clean up on aisle 2, somebody spilled it, somebody dropped it. It shrinks, inventory shrinks. It's usually going out the back door. It's usually going to an employee. We don't want to talk about that here, other than to be aware it's a challenge, and we need to have internal controls to make sure that we keep tabs on that kind of stuff and prevent as much as we can, protect the assets. But this is just the big picture, which is the same formulas that we just looked at here. Goods, cost of goods, and ending inventory is goods available for sale. Mass merchandise available for sale. All right, 2 kinds of inventory. Perpetual. If we're selling cars, we're perpetual. I sold that car, I got that cost of goods to go with it. Or periodic. I bought 20 cases of lettuce and I sold 2 heads of lettuce and another head of lettuce and 5 more heads of lettuce. And you're not going to calculate and say, well, perpetual, I had 238 heads of lettuce. I sold 1, now I have 237. I have 4 cases of Kick cereal. And if I got 12 in a case, I got 48 boxes. Am I worried about which box I sold? I sold the box. I have an average cost or LIFO, FIFO we'll talk about later in another chapter. I'm not going to worry about the box of cereal that I bought and the box of cereal that I sold. So perpetual is usually after big ticket items, diamond rings, boats, cars, expensive things. Okay, sometimes computers, TVs, heavy duty, but periodic is actually really common for anything that the food items, anything that's 50 or 100 bucks. We buy a whole bunch of these and we sell a whole bunch of these off the shelf. We get cables, we get whatever going on. So those are things that differentiate periodic and perpetual. Then we have something called cash discounts. Let's talk about discounts. Let's talk about a terms code. All right. So you might see terms like net 30. Okay, that means in 30 days, money's due, pay up. Net 15, net 5. You might see COD, cash on delivery, net 0 basically. But then you might see something funky like 210 net 30. Well, it means if you pay in 10 days, you get to take 2% off the price. You paid a net of 98% of what the original bill was. If you wait to 30 days, you pay the balance at full rate. You're not getting any discount. Okay. So look at 210 net 30. If I have a $100 bill, okay, and this is receivable. So let's do a sale. Okay. So we've got accounts receivable, and I'm going to skip the descriptions right now and just get the account receivable of 100 bucks. And I get sales of 100 bucks. I invoice the customer, I say, here's 100 bucks worth of stuff. I'm going to make that 210 net 30. how much am I going to get paid if they pay within 10 days? I'm only going to get $98 in cash. But they're going to owe me nothing. So I have to relieve the AR of $100, 100%. Because they're not going to give me that $2 ever again. I just told them they didn't have to. So I got to put this $2 somewhere. And if I am the seller, I'm giving you a discount. I've got a sales discount. $2. So what does that mean? Well, it means I'm going to have a net sale from this transaction, $98. So what is that going to be happening here? Well, let's take a look at that. It means my income statement has revenue, originally of 100. I'm going to subtract my sales discount, $2, and I'm going to have a net sales of 98. So sales discount is a contra revenue account. Revenue is normally a credit balance on the right. Sales discount is normally a debit balance on the left. And it's going to net out our net sales. Now we also have something called returns and allowances. We'll talk about that a little later. This is not a return. This is not allowance. This is a sales discount based on our terms code. So let's go turn on here. Control U, and we're good to go. All right. So hopefully that makes a little bit of sense. We're going to subtract our returns and allowances. We're going to subtract our sales discounts. We're going to have a net sales amount on the income statement. Then we're going to take away our cost of goods sold. And then we're going to have gross profit. And we take away our SG&A. And we got net income. Take away our cost of goods sold. We take away our SG&A. And we're good to go. All right. So that's the big picture. That's the classified multi-step income statement. A single step has all the revenues in one place, all the expenses in another. But we are having the cost of goods sold separated. A multi-step income statement has cost of goods sold isolated and tells us that, oh, it's a little bit, makes more sense. This is based on what I had to buy that I sold, the products that I sold. If I'm Kohl's or Belk's, hey, I got clothes that I sold and I know what the cost of the clothes are, but then I had to pay my employees that sold it. Then I had to pay the utilities. I had to pay the rent. I had to buy the equipment. I had to buy the shelves. And so all kinds of things that go with that. Cash registers. All right. So in this case, we bought inventory on account. We debit merchandise inventory, credit accounts payable. Notice we didn't expense the inventory yet. Revenue recognition allows us to recognize the revenue when we sold it, and matching matches the inventory sold through what we've been talking about as cost of goods sold. Our 210 net 30, 98 bucks. So let's go look at the discount period and the journal entry. So here we go. What's 2% of $500? 2 times 5 is 10, 10 bucks. So accounts payable, now we are buying the stuff. We bought $500 worth of stuff. We originally put it, and we're taking advantage when we pay accounts payable, we're going to reduce. We originally put it in $500 in accounts payable, $500 in inventory. Debit the inventory, credit the payable. I don't think that's on here. That's okay. So we debit the inventory for $500, we credit the payable. What happens? Got a discount of 10 bucks for the terms. We paid it in 10 days, so we only paid $490 in cash. What I showed you was the seller side, which is just the opposite. We sort of account receivable and it's sales revenue. But here we have accounts payable. We have inventory being reduced because the $500 we paid is fiction now. We really only net cost is $490, and our cash going out is $490. Here's the T account or the ledger to go with it. And then If we pay after the discount period, $500 in inventory stays intact, and accounts payable is clear to 500, credit the cash, debit the payable, you still have the inventory. By the way, shipping, when you buy the stuff, you always add shipping to inventory. We'll talk about it a little bit later. Another concept that's kind of important. FOB, free on board. I was actually talking just to one of my students. She has a job now, and this was like 5-6 years ago, but I just talked to her 2 weeks ago. A job in Wisconsin, and she's using free on board. She said, I learned that. I remember free on board. What the heck is free on board? Free on board means who's responsible for owning the inventory. I'll give you an example. I used to sell cars. I sold Kias. While I was selling Kias, Chrysler, Jeep, and Kia, in the middle of South China Sea, a ship sank carrying a whole bunch of Kia cars, Kia SUVs. A little bit waterlogged. They probably weren't worth as much as they were when they were floating on top of the water. Total loss. They couldn't recover them. They went too deep, and so be it. But whose inventory was that? Did the buyer, which is Kia America, own the inventory, or did Kia South Korea own the inventory? Well, that's a legitimate question. Who is going to make the insurance claim? Who would have, if it was over Christmas, December 28th, they shipped it, January 28th, it arrived, who shows inventory on December 31st for this stuff? Well, the answer, as you know in this class, often enough, is it depends. So what's it depend on? We've got two kinds of FOB, shipping point and destination. So if the goods are, where does the ownership change hands? We got a seller at the shipping point. We got a buyer at the destination. We got a port in Los Angeles receiving the cars. We got a port in Busan Harbor in Korea shipping the cars. I've actually been there. It's kind of an interesting place. You look at this and you start saying, okay, if it's FOB shipping point, the buck stops here. And the buyers is going to put inventory. They're responsible for shipping costs. They're responsible for insurance. And when the boat sinks, they got to worry about it. If it's FOB destination, it happens to be the seller that has to take care of the shipping costs, coordination, insurance, all that good stuff. Now, the reality is the buyer is going to pay the shipping costs. It might just be a higher price, but the catch is FOB destination, until it gets shipped, until it's at the docking, the loading dock of the destination, it belongs to the seller. So if we're shipping on December 28th, it's FOB shipping point, and it's out to sea in January 1st, December 31, that actually the buyer, even though they don't physically have possession, they got to declare the inventory. On the other hand, if it's FOB destination, even though it's out of the warehouse, it's on the boat, it's going across the Pacific, the seller has to include it in their inventory. Both can include an inventory. It's like your personal taxes. If mom and dad claim you as a deduction and you can't claim yourself as a deduction, the same way, two people can't claim the inventory, or two companies can't claim the inventory. So goods in transit, who owns it and who's responsible? So we get merchandise, inventory, cash, transaction costs are paid by the buyer. It's going to go into inventory. It's paid for by the seller. This is a delivery expense. So there's a shipping out expense that a seller can have, but the shipping in a buyer does not have. Terms, FOB shipping point, $75 in transportation charges. You'll see that in the book. I'm not too worried. So itemizing costs. So this is, again, the purchases side, not the sales side. So instead of sales discounts and sales returns and allowances, we have purchase discounts and purchase returns and allowances. Okay? And we have transportation in, it gets added, net cost of merchandise purchase. For sales, I've talked about that. You get sales, net of discounts, and RNA, returns and allowances, plus cost of goods sold is a gross profit. A multi-step income statement, we'll see. Sale merchandise, each sale transaction for a seller involves two parts. That's why it's called quadruple entry accounting. And you'll see it here. We've got the sale and the receivable, and we've got the inventory and the cost of goods sold. If you can remember this journal entry, you can remember merchandising adjustments as we sell stuff. And you're probably want to remember this. Okay. Sales discount, same idea. Let me give you a couple different terms here. If I told you I had 50, 10, net 30, you'll say, you need to tell me you're getting a 50% discount if you pay in 10 days and net if you pay in 30, and I'm telling you exactly that. I was given these terms. Why? Because I used to sell computer equipment, modems, monitors, and they gave me these terms. But this 50% was based on the retail. I wanted to pay wholesale because I had to sell it. I normally didn't sell it for 100% full retail, although sometimes I was able to, but usually I had to discount it. So if I had to pay the retail price and sell it at retail, I make nothing. If I had to pay the retail price and sell it for less than retail, I lose money. So this was quite the motivator, 50, 10, net 30. I'll give you another set of terms that I used. It was 0.02, 10, net 30. State of Wisconsin required the purchase of goods, you must take all discounts offered by vendors. I didn't offer 210 net 30. I didn't offer 110 net 30. I didn't offer 0.2. I offered 0.02. But legally, state of Wisconsin, they had to take the discount, and I didn't take the hit for 2%. I took a hit for 0.02%. And so it was pennies on the dollar, but it got me paid sooner, a lot sooner. So by law, they had to take advantage of discounts. Discounts are whatever you negotiate, whatever you agree to, however it works. And as we said, if you pay after the discount period, you pay in full. If you pay before the discount period, you have to take care of the discount. But either way, the receivable is going to get reduced by $1,000. One time I get cash for $1,000, one time I get cash for $980. I got to put the $20. Sales returns and allowances. Let's talk about returns and allowances. Returns and allowances. If you return stuff, we've got to return this quadruple entry accounting and reverse it. We reverse the inventory and the cost of goods sold. The goods came back to us. We reduce the revenue and the cash because we gave it back, or the revenue and the receivables. So we're reversing all that. Sometimes, let's say you bought a TV from Best Buy, they deliver it, and you said, there's a scratch on the back of the TV. And Best Buy says, you know what? I can take the TV back, I can get you a new TV, and we can, or a refrigerator, or a washing machine, or whatever you got. But I tell you what, I'm going to give you a $50 gift certificate at Best Buy, and just keep the TV. It's the back of the TV, don't worry about it. It's the side of the fridge, no one's going to see. And then you make a choice, like accept the $50. Some may say, well, if it's a fridge that got knocked around, it's going to fail early, and no, I just want a new fridge. Or I want a new TV. It's electronics. I don't want to mess with my electronics. Others will say, it's a scratch on the side of the dang refrigerator. And where it looks, nobody sees it. I can't see it. And we just pull it out to clean it once a year, and big deal. So you might take the $50, or you might negotiate for $75. But then what they can do is, under that formula we had up here, they will deduct the returns and allowances and not have to worry about taking back the inventory and shipping the refrigerator back to Samsung, or taking back the TV and shipping back to Sony or Panasonic. They just say, here's $50, they deduct it, they eat it, and you get a better deal, and they don't have to hassle it. So that's considered an allowance instead of a return. A return is actually, okay, we took the goods back, but then we have to put it back in inventory. Even if it's damaged, we have to account for the inventory side of the transaction. All right, so sales with returns and allowances. The catch here is, though, if you return something, you can't take a discount on the gross receivable because the actual amounts have been reduced. So we actually sold something for $15, our cost was $9. But the catch is, if we had that $100 sale and we returned $75 worth of stuff, now it's $25 sale. We'll take a discount on the $25, not on the $100. So be careful of that, because you can't get a discount on something you didn't buy. And that's why it's going to be a discount on the net that's due. So returns and allowances, they're $10. Cost of goods. and adjusting entries. So this I want to be clear. Multi-step income statement we mentioned has gross profit. So we got revenues, less discounts, less returns allowances for net sales. Then we have cost of goods sold, and we have a gross profit. Then we have all kinds of expenses: depreciation expense, sales salary expense, rent expense, store supplies expense, advertising expense, total selling expenses. There's our selling, and there's our G&A, general administrative. Depreciation on the office equipment, office salaries, insurance, rent, office supplies, total, and we have total operating expenses. Income from operations. That's from the stuff we do every day. And then we have some other stuff outside. The multi-step has non-operating activities at the bottom. Interest is non-operating. Gain on sale of building, that's kind of a one-shot deal. The same way interest revenue, interest expense shows up here. And that's the total of other stuff. For a bottom line net income, notice it's double underlined. We talked about this before. There's a dollar sign at the top of the column, a dollar sign at the bottom of the column. Okay. And what we have is a net income that's double underlined. All the rest are single underlined for subtotal. Single step just has all the revenues, interest, sales, gains, loss, and on the building. Our expenses have losses, interests, all that stuff together. A single step is not as informative as a multi-step. The same numbers are there. It's just nicer to be able to see gross profit. Classified balance sheet. We talked about separating current assets from non-current assets. And it's an order of liquidity. Cash is most liquid because it is cash already. Receivables turn to cash pretty quick. Inventory is a little bit slower. Office supplies get used up over the year. Store supplies, prepaid insurance, that's over the year, 12 months to 24 months, whatever it might be. So in order of liquidity, how fast it gets turned to cash or used up. Then we have, instead of the current ratio that you learned about in chapter 2, we have the acid test ratio or quick ratio. Let me tell you the difference. A bank doesn't care about your inventory. Okay, of course they care. But when they're going to do a current ratio analysis, they don't know the value of your inventory. They don't know if you're a wine shop, if the wine is vintage because it's 10 years old, or it's worthless and it's vinegar. They don't know if the computers you have on the shelf are the latest and greatest, or they're 5-year-old computers. They do know that they don't know anything about inventory. So they will take away the inventory and prepaid. So in the numerator, instead of all current assets and the denominator all current liabilities, the asset test is going to be lower. And they're going to take cash, short-term investments, accounts receivable, so a subset of those current assets to calculate the asset test ratio, also known as the quick ratio, versus the current, which includes everything in the numerator, all the current assets. And 1 is kind of liquidity mark, but 0.8 or 0.9 is fine for some industries and businesses, especially cash businesses like restaurants, department stores. Some are at 1.5 or 2. Question, can you have too much cash? Would you rather have a company that has $1 million in cash or $1 billion in cash sitting on the balance sheet? Think about it. I'll tell you, if Apple had $100 billion on the balance sheet, I'd say, how much money are you making on that $100 billion or on the billion or 100 million? You got it in the bank and they're paying you 0.5% a year, 1% a year on a good day. I expect more than a 1% return when I buy Apple stock. If you're only going to make 1% a year, I want my money back. I'm going to give it to somebody who's going to make money on the money that I invest. So you could have too much money sitting on your balance sheet in cash. Unless maybe you're holding off to buy into the company, there may be reasons that you have a cash reserve. Maybe I've got a bond payable issued coming due. I've got a reserve that I need to pay that $100 million in bonds off next year. All right, I'm going to accumulate some cash to do that. But normally, if you got a cash sitting there, it's wallowing and doing nothing. So do something with it. Asset test ratio, we're looking at Under Armour, 3 years. We're looking at Nike for 3 years. You said current ratio is higher, 2.9, 2.8, 2.5, 1.8, 1.6, 1.5. Asset test was under 1. No big deal, current year. They actually had a loss last year. Under Armour doesn't always have profits. 2.2, 2.9. So their liquidity is going down, where liquidity for Nike is going up. So they're better able to pay off their current obligations using current assets, or current liabilities to use to pay, using current assets to pay those off. Gross margin, talk about the gross profit ratio. Net sales minus cost of goods sold is gross profit. Gross profit divided by net sales. So we did that example. We had $2 a gallon of milk. We had $1 in cost of goods sold. We had a net $1 in gross profit. We have a 50% gross profit margin. And then we take away SG&A, and we took away 90 cents in SG&A. We had 10 cents left. Our net income percentage itself was only 5%, 10 cents out of $2. Periodic inventory system versus perpetual. This kind of walks you through the journal entries associated. And again, I encourage you to read that in the book and see what that means, see how that works, and we can talk more about it. That's the chapter. That gives you some insight, hopefully, on what we're trying to do in chapter 4. And if you have any questions, again, I'm at your service, available. And I look forward to hearing, seeing, and you've got some quizzes or you've got some tests, and I know you will do fine if you prepare. So I know you will prepare. Good luck, and we look forward to seeing you again soon. Thank you.